So basically we said that every parent have to prepare a consolidated financial statements. So if we have got the ultimate parent, this ultimate parent have to prepare one set of consolidated financial statements, including the ultimate parent, intermediate parent, and the subsidiary. This intermediate parent, because it is also a parent company, have to prepare another set of consolidated financial statements, including this intermediate parent and the subsidiary. In this three-tier situation, we have got two consolidated financial statements. Therefore, strictly speaking, if you have got 5 tiers, you have to prepare 4 sets of consolidated financial statements. Sometimes we consider this too troublesome. Therefore, under Hong Kong Financial Reporting Number 10, we have got an accounting exemption. A parent need not present consolidated financial statements if it meets all of these following conditions, all these 4 conditions. So this intermediate parent may be exempted from preparing consolidated financial statements if this intermediate parent is a wholly owned subsidiary. Basically, if this is a wholly owned subsidiary, ultimate parent is the only shareholders. Or if this is a partially owned subsidiary of another entity and all the other shareholders or the other owners do not object such non-presenting, so no one object that we don't prepare a consolidated financial statement by this intermediate parent. And also for this intermediate parent, is debt or equity instruments cannot be traded in a public market. So this intermediate parent must not be a listed company. If this is a listed company, all listed company must prepare its own consolidated financial statements. And also this intermediate parent has not filed, nor is it in the process of filing its financial statements with Securities Commission's regulatory organization for issuing instruments in a public market. So that means this intermediate parent is not in the process of IPO, right? So therefore they will not need to present their financial statements with the regulatory organizations. Also, one more condition is the ultimate parent or any intermediate parent above this intermediate parent, any company above it, they will prepare a consolidated financial statements available for public use that comply with the Hong Kong Financial Reporting Standards or the International Financial Reporting Standards. If this is the case, this intermediate parent can be exempted from preparing the consolidated financial statements. One exemption and one exception. These exceptions applies to the investment entities. So what's an investment entity? Investment entity is an entity that obtains funds from the investor for the purpose of providing investment management service. And this investment entity commits to the investors that it will invest fund only for return from capital appreciations and the investment income or both. And this investment entity will measure and evaluate the performance substantially using fair value. So basically, investment entities may include those private equity organizations, venture capital organization, pension funds, and any other investment funds. So we understand that the only purpose of those investment funds is they want to invest and make money. Therefore, they have no intention to run the business itself. And therefore, we don't ask this investment entity to consolidate. Instead of asking them to consolidate, we simply ask them to measure all the investments at fair value through profit and loss. For investment fund, the best way to consider their performance is whether their investments value increase or not, right? It's not consolidation. It's not just consolidation. They don't run the business. It's the fair value more important. Therefore, if this is an investment entity, we don't ask them to consolidate. We simply ask them to measure all the investments at fair value through profit and loss. So that is for a subsidiary. For a subsidiary, we consolidate. But in addition to a subsidiary, we may have an associate. So what's an associate? Associate is an entity over which the investor has got significant influence. So if we don't control, if we have got significant influence, this is an associate. So what is significant influence? Significant influence is the power to participate in the financial and operating policy decisions, but we cannot control, and there's no joint control. If this is control, subsidiary. If this is significant influence, associate. This is joint control, we call it joint arrangement. So what is joint control? Joint control is the contractually agreed sharing of control of an entity, of an arrangement, which exists only when decisions about the relevant activities require the unanimous consent of the parties sharing control. That means there must be a contract. There must be an agreement where more than one party enter into the agreement and then they together control. There must be a unanimous consent. That means they all must agree. This is joint control. If this is a joint control, this is a joint arrangement. Joint arrangement is governed under International Financial Reporting Standard number 11. So that means arrangement of two or more parties have got joint control. And they can exercise a joint control all together. So it requires a unanimous consent of all parties, and no single party can decide. There can be two types of joint arrangement. One is joint venture, another one is joint operation. Joint venture will use equity method. We'll talk about equity method later after we know how to consolidate. If you set up another entity and you operate, this is usually a joint venture because you mix up your assets and liability with other party. So this is a joint venture. The other way around, say for example, if we construct a building, of course you can set up an entity which construct the building, and therefore this entity may be your joint venture or maybe your investment in associate, investment subsidiary. But instead of setting up a separate vehicle, you can bring your own machine, you can bring your own staff to build. If I'm very good at mechanical engineering, I will do the mechanical engineering work. Some other parties may be very good at the lift, maybe very good at other stuff, say for example the drainage. Right? Some other parties may be very good in civil engineering. They will bring their own machine, they will bring their own staff. So each party, each investor, each joint venturer, right? So they may bring their own expertise there and they come together. We don't mess up our assets. We don't mess up our revenue. We don't mess up our expense. We don't mess up our liability. So each party account for its own asset, liability, expense, and revenue. If this is the case, this is not a joint venture. They come together and they build a building. They share the profit thereafter. This is a joint operation. So if this is a joint operation, because you never mess up your assets, liability, income, expense together, you can account for your own assets, your own liability, your own expense, and your own revenue, and therefore this is a joint operation. So if this is a joint operation, we don't any special kind of accounting method. We simply account for your own expense, assets, liability. So this is joint operation. But for joint venture, you need to use equity method. So, significant influence, associate, this is not control, this is not joint control. Significant influence, usually if you have got 20%, we assume that you have got significant influence. So the magic number is 20% or more. So if you have got 20% or more, we don't argue, you have got significant influence. Sometimes you can say that even though you got less than 20%, you still have significant influence. You may be trying to demonstrate a significant influence if you have got evidence that Say for example, you have got representation on the board of directors. If there are 5 directors, you can always appoint 2. Basically, you can exercise significant influence. If you can participate in the policy making process, you got significant influence. If there are significant transactions between the investors and the investee, say for example, all their materials, all their inventory is supplied by you, then you may say that you can have a significant influence. There is an interchange of managerial personnel. Say suddenly, director of company A can become director of company B, and director of company B can suddenly become director of company A. They can interchange suddenly. Then obviously you may be able to exercise significant influence. If you can provide an essential technical information, say for example, you can supply a secret formula that the other company cannot operate without your secret formula, then probably you can exercise significant influence over that company. This is also significant influence. So whenever you have got significant influence, we say that this is associate. Just like before, say for example, if P can control S, this 50% will count from the viewpoint of P. P have got 50% over Y, only 50%. We cannot control Y. Therefore, Y is not a subsidiary, but at least Y is an associate of P because you got 50%, 20 to 50%. Usually we don't argue, you got significant influence, and therefore Y is an associate of P. Because P cannot control Y, therefore this 50% Y over Z will not count. Therefore, from the viewpoint of P, P can only exercise 50% power over Z. If this is only 50%, we will not consolidate Z, but Z is certainly an associate because we can exercise significant influence over Z from the viewpoint of P. Right hand side, situation 2. P have got 40% over A, only 40%. P cannot control A, and therefore this 80% will not count from the viewpoint of P. P got 50% over C, only 50%. We cannot control C, therefore this 20% will not count. So therefore from the viewpoint of P, P cannot control A, therefore the 80% will not count. P cannot control C, therefore this 20% will not count. Therefore, the relationship between P and B is nothing. Of course, A control B. Of course, A control B, and therefore B is a subsidiary of A. Okay, so B is a subsidiary of A. So, P cannot control C, therefore C is not a subsidiary. So, as a summary, so this is what we have discussed so far. So if we have got a control, so if one entity control another entity, this is a parent-subsidiary relationship, and therefore Hong Kong Financial Reporting Standard number 3, business combination, and also Hong Kong Financial Reporting Standard number 10, consolidated financials apply. So if this is a subsidiary, we have to consolidate this subsidiary. If we don't have control, but we have got joint control, if this is a joint control, joint arrangement. So depending on whether this is a joint operation or joint venture, if this is a joint venture, we need to use equity method, and therefore Hong Kong AS 28 applies. So equity method is the method that we use for an associate. Therefore, the applicable accounting standards for the equity method is also 28. Accounting standard number 28. If we don't have control, if we don't have joint control, if we only can exercise significant influence, then this is an associate, as I've said before, equity method. If we don't have control, if we don't have joint control, if we don't have significant influence, then this is just like my investment in Hong Kong Bank. This is only a financial asset. If this is a financial asset, then Hong Kong Financial Reporting number 9, financial instruments applies. So you must have studied financial instruments under financial reporting number 9 before. So therefore, for this course, we concentrate on consolidation and equity methods.